of course, to services. We also think there's another fear brewing out there, and it's China. Now, we hear a lot of headlines about China, but I'm not seeing many economists even integrate what's going on in China into their forecasts. China has been a powerful growth engine for the global economy for the last really 20 years. And they are changing their spots. Growth does not seem to be China's primary objective anymore. Common prosperity does. And they are restructuring in many ways. I think that's going to slow things down quite a bit, their economy. And of course, China has an impact not only on the rest of Asia, but especially Europe. I think Europe and China are much bigger trading partners than China and the US. Nonetheless, commodities are global. And so what hits China and these other economies is going to impact pricing. In fact, we're already seeing that, and I'll get into that in a moment. But let's talk about what the market's really worried about and why the impact has been so severe on fast-growing companies with high valuations, at least high valuations if one is looking at this year or next year. As you know, in our world, we're looking 5 years out, and we assume massive multiple compression over that time period to get to our price targets. Well, the market is really worried about inflation, and the headlines this week have been the highest rates we've seen in 38 to 40 years. And for some measures, that is true. I mean, the headline measures are concerning. I understand that. The PPI year over year is up 8.3%, CPI 5.3%. The personal consumption deflator up 4.3%. That last one is the one that the Fed pays a lot of attention to. So as you know, last year, we anticipated high inflation. It's a little higher than we thought, not much. One of the reasons was because of the base effect, the collapse in prices around the coronavirus last year. Well, we are passing through that, and still these numbers are high. So we do have to answer to that. And